Hello, thank you for joining us for our 2020 year-end payroll and reporting webinar presented by Hawkins-Ash CPAs. Thank you for your patience as we got a few bugs worked out and we should have a smooth presentation going forward. Hawkins-Ash CPAs provide certified public accounting services to privately held businesses, governmental organizations, nonprofit entities, housing authorities, and credit unions. The firm currently has offices in Green Bay, La Crosse, Manitowoc, Marshfield, Medford, and Mequon in Wisconsin, and Rochester, St. Charles, Winona in Minnesota. To learn more about Hawkins-Ash CPAs, visit us online at hawkinsashcpas.com. As a reminder, all attendees are in listen-only mode. If you have questions, please enter them in the question box in your GoToWebinar control panel. Becky Doyle is watching for your questions and will answer them as they are entered. Becky is an associate here at Hawkins-Ash CPAs and a certified payroll professional. The handouts for today's session are available in the GoToWebinar control panel. They are linked there. You can just click the link. Along with the recording of the session, these handouts will be emailed to you next week and will also be available in the CPA HQ section of our website. I would like to now introduce Debbie Denny, our presenter for today. Debbie is the Accounting Services Manager in the Green Bay office of Hawkins-Ash CPAs. She specializes in software consulting, training, and small business accounting and tax preparation. She is an advanced certified QuickBooks desktop and online pro advisor and has been certified for more than 20 years. She is also experienced in Sage 50 software. Please join me in welcoming Debbie Denny.
Thanks, Corey. I'm Debbie Denny, and we're going to get started right away. No chit-chat, because there's a lot of things to go over today. What I'm going to do is I'm going to concentrate a lot on some of the new things that are happening in payroll and benefits, because this year has been a whirlwind. So we'll get started. I'm going to take a couple 5-minute breaks throughout the presentation today, just because this information can get dry and boring, and I don't want you guys falling asleep. So we're just going to go through and I'll give you some breaks. So please be aware of that. So we're going to start with our topics of, let's see here, change slides. Oh, one at a time. We're going to start with our changes. There's going to be a lot of changes that we're going to talk about. And the biggest one being is the second bullet point, which is the pandemic and payroll. We're going to talk about W-2 information, pre-tax benefits, fringe benefits, exempt versus non-exempt employees, employees versus independent contractors, and the Affordable Care Act. So some changes that came up in 2021 is that the employers may now truncate the employee's Social Security number on the employee copies of Forms W-2, which are copy B, C, and 2. So those are the copies that go to the federal government, the state government, and the employee copies of the Form W-2 in the multi-part. You cannot truncate the Social Security number on copy A or any of the government copies. That's a big change. It's something we've been asking for a long time. If, as an employer, you use your Social Security number as your employer ID number, you cannot truncate that. So if, as a sole proprietor, say you had employees and your Social Security number is your company ID number, you cannot truncate that. And if you are preparing a form or filling out a Form W-9, you cannot truncate that either. So those are things that we need the full Social Security number on. The FFCRA and the CARES Act, there's forms changes related.
Corey.
Yes?
Your slides are not advancing, so we'll need to switch which slide you're sharing.
Are you in the 2021 changes window?
It's showing the first slide,
Oh, still the first slide?
yeah.
Okay. I'm not sure why that would be. Let's try a different one. What does that one show?
Yes, we're on the slide that says 2020, 2021 changes. So I think we are
Okay.
caught up.
All right. Thank
Thank
you.
you.
I just had it on the wrong button there. All right. Thanks, Corey. We're also going to talk about the FFCRA, the CARES Act, and the form changes related to both of those, and Form 1099 NEC, which is an old form, but they brought it back this year. Some reminders is that the Department of Labor raised the white collar salary in 2020. So this is that you have to pay salaried employees so much per week. You can't have them as salaried unless you are paying them that much per week. So that's something to keep in mind. I know there was a lot of commotion regarding that, but just if you're interested in seeing more on that, you can go to the Department of Labor website. The W-2 electronic filing is required if you have over 250 employees, and that is for federal. For Wisconsin and Minnesota, it is 10. And that number, the IRS is talking about limiting that to 100 employees, possibly next year. And then there's also that new W-4 form that came out last year that the employees, any new employees, any employees that want to adjust their withholding need to complete that form. And if they are completing that form and want to claim exempt, you need to write it in under box 4. The W-4 is rather confusing, and on the IRS website, there is a withholding estimator that's available to help your employees complete that form. Then here's the key fact sheet for 2021. The Social Security limit has changed. We do not yet know the Minnesota unemployment wage limit. Minimum wage changes for Minnesota, depends if you're a small or large employer. For the cities of Minneapolis and St. Paul is based on the employer size. Minneapolis also has an anti-theft law, and there are sick leave available as of January 1st of 20 for Duluth, Minnesota, and St. Paul. Retirement plans, there haven't been a lot of changes there. There has been changes in the HSA single family, and also the cents per mile has not been published yet. That normally comes out, I believe, in January, some early January. So not a lot has changed. Now we're going to talk about the big subject, the pandemic and payroll. There are 3 different things that came out regarding the coronavirus pandemic. The first one was the Families First Coronavirus Response Act, or as I call it, FFCRA. And what that is, it's an Emergency Paid and Sick Leave Act. And if you go to our website, I do have a calculator out there that you are able to calculate wages on. What this did is the act provided for payments for employees that were sick, experiencing symptoms, having to care for their children, things like that during the government shutdown and afterwards. This provision is in place through 12/31 of 2020, and it is for employers with under 500 employees it affects. So there's pretty much 6 different 6 different items that you need to look at for your sick pay, whether it's the employee is sick, or if there's the employees caring for a sick person. So those are the 2 different items. The first one, the employee can get up to 2 weeks, 80 hours of paid sick leave, up to $5,110 total. When the employee is caring for someone else, they can get up to 2 weeks paid at 2/3 their regular pay, up to $2,000 total. Then there is the Emergency Family and Medical Leave Act. So it's the expanded family medical leave. They added some additional things. If the employee is unable to work because they're caring for a child because school or the place of daycare is closed, um, they can get paid. So the employee has to have been on the job at least 30 days. The first 10 days can be paid or unpaid, and the employer may require the employee to use accrued PTO. Under this circumstance, the employee can get up to 10 weeks of pay least at least 2/3 of their salary at minimum of $200 or maximum of $200 a day and $10,000 total. So for the employer, these selections with FFCRA are fully refundable tax credit, which means it technically does not cost the employer any money. It's not subject to the employer Social Security. If the employer is maintaining health insurance coverage on the employee, that full cost of health insurance is a credit, and also the employer portion of Medicare is a credit. So you want to take that into consideration because there are calculations that need to be made regarding that. And when you see the example of the spreadsheet, you'll see that. So just some things that count and don't count toward this credit. Employer contributions to HSAs do not count. Employer contributions to HRAs or FSAs do count. You can pay this leave after the fact as long as it occurred between April 1st and December 31st. So if you didn't know about the FFCRA and you had people that were on leave, you can go back and pay them now and take those credits, but you're going to want to do it quickly because the end of December is coming up shortly. And also, this is the accrual basis for leave payments. So if you're paid in January for December wages, you can still take that credit. For the employee, these sick leave wages are taxable. And for those employees' wages, they are considered wages for retirement contributions. So if an employee has a percentage of their wages withheld for their 401k, the FFCRA wages would be included in those total wages. And to receive this credit, excuse me, you either reduce your 941 EFTPS payment, you file a Form 7200 to receive an advance, or you can claim a refund on your Form 941. Okay, so here's an example of the spreadsheet. So we're going to say that Sally was told to self-quarantine by her doctor for 4 days. She normally works 8 hours a day. Her hourly rate is $15 an hour, and her health insurance is $145.77 a month. And that's the full premium. It doesn't matter if it's employer portion, employee portion, that is the full monthly premium. And it has to be pre-tax to the employee to be able to get the health insurance portion of this credit. So in the spreadsheet, which is also available on our website, I'm just going to check the check mark box as the reason for the qualified sick leave related to COVID. So there's 7 reasons. And based on those 7 reasons, the spreadsheet will calculate what the credit should be. So fill in the blue boxes. The employee's rate of pay is $15 an hour. She had 32 sick leave hours, which is 4 times 8, and she had 4 days of sick leave for the pay period. And when I compute her premium, I come up with $4.78 of health plan expenses per day. When I look at the next page of the example, this is all on one sheet in the spreadsheet. QuickBooks is, I keep saying QuickBooks, Excel, the spreadsheet is going to calculate the 941 credit. So this is the amount that's going to be credited on your 941. If for some reason your payroll software is unable to calculate the Social Security portion, then you could use this calculation at the 535.84. But I believe most softwares are up to date now where it should calculate the full 506.08. So if Sally gets paid biweekly, she's got 48 hours of regular hours. She would get paid for the full 80. 48 regular hours, 32 of FFCRA pay. And then say the employer's 941 payment is 22,500, you would short that payment by the 506.08. So in that case, the employer would pay 22,043.92. So you short your 941 payment. Or if you forgot to short your payment, you're going to get that back as a refund on your 941 quarterly form. It also affects your 941. So for your 941, you're going to report the qualified sick leave or family leave wages on box 5A1 or 5A2. Because they are exempt from Social Security tax, you can see the calculation is different. And then there's also worksheet 1 to determine your amount for 11B for your non-refundable portion, if you've got a carryover for the next quarter. So here's a sample of the worksheet. For W-2 reporting on FFCRA wages, these get reported in box 14 as a separately reported item as sick leave wages subject to the 511 a day limit, or sick leave wages subject to the $200 a day limit, or emergency family leave wages. So that's kind of how it affects your forms. As an employer, be careful that for documentation purposes, the Department of Labor and the IRS require different, their requirements are different. So the Department of Labor doesn't require you to do as many things for documentation of your employee sickness as the IRS. And I do have websites out on the presentation showing you where you can get that information from. Then there is the CARES Act. Excuse me one second. And the CARES Act is the Coronavirus Aid, Relief, and Economic Security Act. And this one, the employer, excuse me, can defer the employer's portion of the FICA tax, which is the Social Security tax only, not the Medicare tax, but just the Social Security tax. They can defer that payment from 3/27 through 12/31, and it's just a deferral. It does have to be paid back. 50% of it has to be paid back by 12/31 of 21, and the remaining amount by 12/31 of 22. The CARES Act also includes the employee retention credit. And with the employee retention credit, you can't claim FFCRA on the same wages. So if any employee had FFCRA wages, you can't use them for part of the employee retention credit. And you cannot claim the employee retention credit if you receive a small business interruption loan under the Paycheck Protection Program. So just a couple things to keep in mind. The employee retention credit is a fully refundable credit of 50% of qualified wages, including health plan expenses. These wages would be paid between 3/13 and 12/31. The maximum is $5,000 per employee. And an eligible employer are employers that had suspension of operations by order of the government due to COVID-19. So most of your restaurants would be eligible, things like that. Movie theaters. If you paid your employees during that time that they were off, you could get retention credit. or if you had a significant decline in gross receipts because people weren't going out and doing things. For the qualified wages, if you have under 100 employees, the wages paid to any employee are qualified. If you've got over 100 employees, the wages the employees that could not work because of one or two in the previous slide, those wages may not exceed what the employee would have regularly been making during that time. And for the significant decline in gross receipts, they look at a calendar quarter from this year to 2019, and if those are less than 50% of gross receipts for the same quarter of the prior year, that would qualify you. And also, it ends the first quarter that follows the first quarter that the employee's 2020 gross receipts for the quarter are greater than 80% of those gross receipts for the same quarter of 2019. You get a credit of Social Security taxes on, let's see, we already discussed that, and getting the $7,200 for the advance. So that's how you would get your credits. Then there is the executive order, which came to a lot of people as a surprise, I guess, at least the software companies, where it allowed the employee to defer their portion of Social Security tax from 9/1 through 12/31. Again, this is a deferral, and these deferred payroll taxes need to be paid back by April 30th. And if you've already made your tax payments, you cannot go back and unpay by shorting your current future payments. So if you've made those tax payments, they're made, you can't defer anymore. But just know that this is a deferral. If your employee has deferred their Social Security taxes and say were to leave in the first quarter of 2021, you as the employer are responsible for paying back those deferred employee payroll taxes. So if your employee has deferred the portion of their Social Security tax, on the 941 form, you're going to report the employee deferral on line 13B. And if as an employer, you also deferred your Social Security tax under the CARES Act, you would report that also on line 13B. For the W-2, you're going to include those wages for which you deferred withholding and payment of the security tax in box 3 and box 7, which is your Social Security wages and, let's see, your Social Security tips. Do not include in box 4, which is the Social Security tax, the amount of the employee's Social Security tax that they deferred that has not been withheld. Then in 2021, when the employee pays back the deferral, you're going to have to file a W-2C for that employee for 2020 to correct box 4 to increase the amount of the deferral to actual. We're expecting more guidance to be released on this in 2021. But if your employees did defer, it sounds like it's going to be a major headache. So just warning you. And speaking of the W-4 or W-2, here's Form W-2, and I'm not sure why it did not update. Hang on, I can probably, I won't be able to pull it up. But the only change for 2020 is that the year is different. There were no other changes. Just in general, for the W-2 form, they will be rejected by the IRS Social Security Administration if the Medicare wages and tips are less than the amount of the Social Security wages and tips. The Social Security wages and Social Security tips are equal to 0. Medicare wages and tips are equal to 0. It's going to be an automatic rejection. The due date for filing your W-2s with Social Security Administration is February 1st, and extensions to file your W-2s are not automatic. You can request a 30-day extension, with Form 8809, and it has to be requested before February 1st. And to calculate your taxable wages for the different boxes in the W-2 form, your federal taxable wages are federal, less pension 401k plan amounts, less Section 125 cafeteria amounts, and those are the federal wages that go on box 1 of your W-2 form. So as you can see in my example, I've got my wages minus my Section 125 health care, which is my pre-tax, minus dependent care, which is also pre-tax, and that's the net taxable wages, which happen to be the taxable wages for Medicare, minus my 401k or your other I shouldn't say pre-tax, your other retirement plans that are pre-tax for federal and state. That's the amount of your federal taxable wages that go in box 1. Your Social Security wages is taken on the first $142,800 of wages in this should read 2021. Sorry about that. So that's the new wage base for 2021. Section 125 pre-tax are not subject to Social Security, and the Social Security wages go in box 3. So again, it's my wages minus my Section 125 plans, which is my pre-tax health insurance and dependent care. So in this example, the employee made $240,200. Well, in the Social Security box, the maximum is $142,800. And again, my years are incorrect on the slides. And what I will do is I will correct these slides. And when Corey sends you the copy of the recording and the attachments, I will have those fixed for that. Sorry about that. I had gone through it and I don't know why they did not save. For Medicare, again, we looked at the Medicare wages back when we looked at federal. But also for Medicare, there is an additional 0.9% Medicare tax to the employee if the wages are over $200,000. The Medicare wages go in box 5 on the W-2 form. So again, in this example, you can see $240,200 are the taxable wages for Medicare. You're going to minus $200,000 from that, so then you're going to tax the $40,200 at the additional 0.9% or at 2.35%. This next slide is the Form 2 W-2 Code 12 boxes. And one thing to notice about this is that Code P, which is the eligible moving expenses, those are only for reimbursements paid directly to members of the armed forces. It is no longer available to employees as a fringe benefit. And Code DD, the cost of employer-sponsored health insurance coverage, is required if the employer has over 250 W-2s in the prior year. Supplemental wages are wages that are not normal to your hourly salaried people, and that includes bonuses, commissions, sick leave payments, severance pay, awards, prizes, back pay, all these different things. They're technically called supplemental wages, and you can combine them with regular wages. Let's see here. If you don't specify them, you're going to withhold your federal income tax like your normal pay period. If you do separate them, if you pay them separately or combine them singly, you can either withhold at a flat rate of 22 or withhold like a normal pay period, which I find is the easiest thing to do. And any employee that receives more than $1 million of supplemental wages during the year, you would withhold at 37% without regard to the employee's W-4 form. So again, if you're giving bonuses of over $1 million, those would be supplemental wages and the withholding would be at 37%. For Wisconsin, you would withhold like a normal pay period, or you would estimate the employee's annual gross salary and apply the flat percentages that are available at this website. In Minnesota, again, similar to the federal, if you pay it with them together, you just withhold them like a normal pay period. If you pay supplemental wages and list them separately for Minnesota, you're going to either withhold them like normal or withhold them with at 6.25% on the supplemental wages. And if they're listed separate, totally separate, or paid totally separate, you withhold again at 6.25%. And I think right now what I'll do before I bore you to death is take a really quick 5-minute break, and then we'll talk about 401k deductions. And my clock says it is now 12:37, so let's come back at 12:42. So get a stretch in, you'll need it. There's a lot of information that we're going to go through. And we're back. I hope you can all hear me. I just chatted with Becky a little bit, and she said she's getting a lot of questions on the FFCRA. And hang on one second. I believe my headset is getting low on battery, so give me one sec. Okay, I'm back. So just keep in mind that when the FFCRA came out, it was very early in the pandemic, and a lot of people kind of forgot about it because people weren't getting sick at that time. Nowadays, it's pretty crazy with COVID, and a lot of people are getting sick and needing that time off. Believe me, I was one of them. Um, so that's why it's gotten pushed up to the present, and a lot of people had forgotten about it. So, like I said earlier, if you did have somebody out on FFCRA, and you can go back retroactively and pay them for that. So, and again, you'll get a credit on your 941 because you've already paid taxes on that, on those wages. Or let me retract that. You won't be penalized or anything like that if you go back and pay that employee. So just wanted to reiterate that. So now we'll talk a little bit about 401k deductions. I'm not going to go into a lot of information on this because not a lot has changed with the 401k. And I do have a lot of information in the slides. So 401k codes for the different type of retirement accounts, when and when you should not check the checkbox on the W-2 form, flex spending accounts. There's three different types: dependent care, adoption assistance, and your health care FSA. One thing the CARES Act did is allowed the FSAs to be used to pay for over-the-counter medical medications without a prescription, and that even includes certain menstrual care products. And that's retroactive to purchases beginning at 1/1 of 2020. So any over-the-counter medications that you would have purchased from the beginning of the year, you can use your FSA to pay for that. The FSA provisions, they're either you use it or lose it by the end of the year. And the employer can use it carryover or grace period under a special rule. And the carryover option is the employee is able to carry over up to $550 of unused funds, or there's a grace period option where employee has 2.5 months after the end of the plan year to incur expenses. You can do one, but not both. Dependent care, not a lot has changed with this. Let's see. Let's see. The employer has to give the employee an annual statement, which is the dependent care that they've had withheld that goes in box 10 of the W-2. The employer can pay dependent care, can contribute to that. And if the employer contributes to the dependent care for the employee, it cannot exceed the $5,000 limit per year. And the expenses are for when the cost is incurred, not when it is paid. So it is an accrual basis. Then there's adoption assistance. The maximum amount of an employer subsidy for qualifying child adoption that can be excluded from an employee's gross income is $14,400. So if the employer contributes that much, it is not going to be considered wages or a fringe benefit to the employee. Those reimbursements have to be necessary and reasonable expenses, and there is a phase out if the employee's adjusted gross income is higher than 2016 $660. And again, if you want more information on these types of plans, they are available on the IRS website. Then there is the health insurance premiums of 2% and over shareholders. So if you have an S corporation and your owner is over 2% of the has over 2% of the 2% or over of the ownership, the health insurance premiums are considered wages and subject to withholding, but they are not subject to Social Security, Medicare, and unemployment taxes. They are normally what we do with S Corp shareholders is it's an add back to their W-2 and as a fringe benefit, and it is taxable for federal and state, and it has to be reported in box 1 for federal wages and in your state wages box, but it's not going to be included in the Social Security and Medicare boxes. So if the shareholder has health insurance but nobody else in the company has health insurance through the company, then it is taxable in full to the S corp shareholder. So you can't really discriminate. Then there are HSAs. So if as an employer you have a high deductible health plan, you can have an HSA set up. The HSAs are pre-tax to the employee, and those contributions go into a special account that the employee sets up, and they're used to pay current and future medical expenses. Partnerships and S corporation, again, they're not eligible for a pre-tax salary reduction, and employer contributions to those S corp shareholders or partners are considered a distribution or a guaranteed payment. A high deductible health plan must have the following minimums and maximums. And then we'll talk about some fringe benefits. So personal use of a company vehicle. There are several different ways to go about this. The personal use is considered wages like a fringe benefit, and they are reported on your W-2 as wages. The employee should be tracking their mileage between business and personal usage. And if it is 100% business use, then it's not going to be taxable to the employees. There's different valuation methods. Publication 15B has them all. We're going to quick go over a few of them. So the general valuation is going to be the cost that the employee would incur to lease the same vehicle at the same geographic location. Then there's cents per mile, a lease valuation, and a commuting value. So we're going to look at the commuting rule, where the employer adds $1.50 for each one-way commute that the employee makes using the company vehicle. And there's certain conditions to be met with that rule. I'm not going to bore you going over them because they are right there. Then there's the cents per mile rule. And if the vehicle value when it's made available to the employees is over $50,400, you cannot use this method. The 2021 standard mileage rate is not published yet. Let's see, and the fair market value for personal usage is determined by using the standard mileage rate per mile. So for 2020, it's 0.575. And if you don't provide fuel to your employees, you can reduce that rate by 5.5 cents. And for this rule, you have to have at least 50% of total mileage must be for business. And the vehicle should be used in part of an employer-sponsored commuting pool. There's a mileage test and a consistency requirement. Then there's the annual lease valuation, which is determined by multiplying the annual lease value of the car by the percentage of personal miles driven. And if you go through and take a look, the IRS has the annual lease tables. These haven't changed. They are also published in 15B. And here's an example of the personal use of auto. There is a spreadsheet that is included in the attachments to this webinar that has an example of the spreadsheet attached. So if I bought a 2020 Corvette, which I would love to, this is the amount that it would cost me, fair market value. So it goes through and shows you the calculations and what the add back is for the personal use. And that add back gets added back to the employee's W-2 as a fringe benefit. And here's my new car. Then another fringe benefit is the group term life insurance. And it's non-taxable on the first $50,000 of coverage. Now, there's certain rules. If it's group term life, it's going to provide a general death benefit that is not included in income. It's going to be provided to a group of employees of more than 10, even if not all 10 or more want to choose that benefit. If you've got 11 employees and only 3 of them choose the benefit, that could be still a group term life. It provides insurance to each employee based on a formula that prevents individual selection. So the formula is going to be based on maybe years of service or something like that. And it's going to be provided under a policy that the employer either directly or indirectly carries, but the employer is going to be the one more or less receiving the bills, and maybe the employees pay 100% of the premium. This does not include like a travel insurance, policy of accidental death and dismemberment, or insurance on employee spouses or dependents. The amount over $50,000 is going to be taxable income, and any amount that the employee pays as a payroll deduction is going to reduce that amount. And that gets recorded in box 12 of the W-2 with code C. There is non-discrimination testing. And if it's less than a full month of coverage, you can prorate the cost. And if you are a 2% or greater S Corp shareholder, it is all considered wages. It can be non-taxable to the employee if the beneficiary is the company for the entire year, if the beneficiary of the policy is a charitable organization for the entire year, or if the employee terminates during the year due to a permanent disability, group term life would not be taxable. So here's kind of the calculation of figuring out the group term life. Here is the table from publication 15B, and here's an example. And again, this is in a spreadsheet that is attached to the GoToWebinar handout. If your employer offers spouse-dependent group term life, it's non-taxable if it's under $2,000, and it's normally calculated based on the age of the dependent. For former employees, any group term life over $50,000 provided to a former employee, including retirees after their termination, the employee share of FICA on that period of coverage is paid by the former employee and is not collected by the employer. It gets paid by the former employee on their personal tax return. As an employer, though, you still have to make your share of FICA payment on that. And for the employee, those uncollected amounts go on box W-2 or box 12 of W-2, codes MN. And then if you are offering fringe benefits, here is a calculation to gross up that payroll. Say you're making a payment at the end of the year for S Corp Health or Group Term Life, and you've already run your last payroll for the year. This is a case where you'd want to gross up your payroll, and it gives you the calculation. You have to be careful if your employee is over the Social Security limit. That's going to adjust the calculation. see. You want to just double check and verify that the benefits are added in the correct boxes and listed with the correct letters in box 14 or box 12. And you can give the employee a separate statement if it doesn't all fit on their W-2. Moving expenses, I mentioned before, they're no longer a tax-free perk. And for the employee, it's an above-the-line deduction. Again, I mentioned earlier that members of the armed forces are able to take that with code P. Third-party sick pay. This is if you have a disability policy for your employees. Third-party sick pay if an employee gets hurt and say they don't contribute to that disability pay, then it's going to be taxable to the employee. If the employee does contribute, if they pay 100% of the premium without pre-tax dollars, if they pay it after tax, it's not going to be taxable to the employee. But if they pay it with pre-tax dollars, it is going to be taxable. You also have to be careful as to who is preparing the W-2. Because if the employer is required to report those wages, the disability wages on the W-2, you're going to have to get that into your software program. On the W-2, you're also going to need to check the box for third-party sick pay. And there is a form, which is, I thought I had it attached, which is Form 88 or 8922, third-party sick pay. And third-party sick pay can get messy, so just a little warning. In the next slide, I have let's see, who is responsible depending on what your policy states. Educational assistance is another perk that employers offer to employees, and it's normally going to be taxable to the employee unless it's provided under an educational assistant program, which is a separate written plan that the employer has for the exclusive benefit of its employees. So that's just something to keep in mind. And there's, again, more information under publication 15. The CARES Act has expanded the definition of educational assistance to include direct employer payments toward student loans for non-job related education. That's one thing that is new again with the CARES Act. Business travel expenses. Business travel expenses are going to be pre-tax if they are under an accountable plan. An accountable plan is something that is you're accounting for. So you are tracking things. You are keeping a logbook, things like that. The accountable plan has to show that the expenses are business related. You have to have proof of the amount, whether that's your mileage log, receipts, things like that. And if the employee is paid out in advance for those travel expenses, they must return anything that exceeds your substantiated expenses. If the employee doesn't return them, then that amount over and above is going to be considered taxable. There is a per diem allowance for traveling each day, and that allowance is deemed substantiated as long as it does not exceed the IRS established rates. And those rates are going to be found at the website below because those per diem rates are different per location in the United States, per city in the United States. Chicago, Illinois is going to have a much higher per diem rate than De Pere, Wisconsin, just as an example. But if you're doing a per diem, it's not going to be taxable as long as it doesn't exceed the IRS rates in the publication. Business travel expenses, your mileage reimbursement is also non-taxable up to the federal standard mileage rate. So as of 2020, that mileage rate is 0.575, and again, the 2021 rate is not yet available. Any reimbursements over and above the federal rate is going to be taxable income. And you are also allowed as an employer to pay less than that federal rate. So I have clients that give 50 cents a mile, which is fine. And as an employer, they're allowed to do that. But anything over and above is going to be taxable to the employee. If you loan your employee money, which I normally don't suggest an employer do, but many of them do because a lot of times you have a great working relationship. Your employee's been very loyal, been there forever. They ran into a hard time. And several times I see that employers make loans to employees. And by doing so, that's fine. But what you have to make sure of is that you are charging that employee a rate applicable to something at least at or above the applicable federal rate. And the applicable federal rates can be found at the website I've got published right here. If you offer that loan at a rate below those rates, that difference is going to be taxable on any outstanding loan more than $10,000. That taxable amount is taxable to Social Security, Medicare, FUTA, SUTA, and it's also taxable for federal, which is included in box 1. If the loan is forgiven or cannot be repaid, then the remaining loan balance is taxable income to the employee in the year it is forgiven. I've seen that happen too. Prizes and awards. Prizes and awards are generally included in income with 2 exceptions. There is a length of service award or a safety achievement award. There are limits for each of these, limit of 400 per award that are non-qualified plan awards, and a limit of 1,600 for the calendar year. The achievement awards are normally given to an employee for length of service or for a safety achievement. It is tangible personal property, a Rolex watch, something that you can touch, something that is tangible. It can't be cash, it can't be gift certificates, it can't be vacations, things like that. It has to be something I can touch and feel. And it has to be given in a meaningful presentation. Well, during the age of COVID, I don't think you can really have a meaningful presentation. So whether you're doing it over a Zoom conference, I guess if you can document you've done that and you've shown that to the IRS if they question it, that's, I guess, up to you and the IRS to discuss. But that award cannot also be disguised as compensation. So again, if all these are met, then it can be excluded from income. Again, the award has to be received after 5 or more years of employment for length of service, and the employee has not received an additional length of service award in the same year or in any of the prior 4 years. Back pay and legal awards. Back pay is compensation, it's pay, and it gets reported on a Form W-2 in the year that it is paid. So if you had an ex-employee go after you for back pay from 3 years ago, say you lost and have to pay that in the year 2020, then you have to issue a W-2 form for that employee in 2020. Then there are different awards for punitive damages, non-physical injury, those type of legal awards. Those are considered income, but they are normally reported to you in a 1099 miscellaneous form. Jury duty pay is any pay that the employer pays above the payment from the courts. That's taxable to the employee as wages. And if the employer requires the employee to turn over that jury pay, the difference between the amount that the employer paid versus the amount that the employee got for jury duty that the employee relinquished to the employer, the difference is going to be taxable. Tips are restaurant worker tips, they barbershop tips, any type of tips that you receive from customers. Um, they are taxable income. They have to be reported to the employer by the 10th of the month if they're over $20. And if the employer wants, the employer can require them to report it more often. There is a Form 4070 on the IRS website that is a form to report tips. And it has to be reported to the employer on a form similar to that if you're not using that form. Service charges. They're not tips, but they're considered wages. So if you're looking at a menu and it says a party of 6 or more will be assessed a 20% gratuity charge, that is going to be considered a wage and not a tip. If you're booking a banquet and there's a fee involved that's separately stated, that is going to be, like I said, wages and not a tip. So there's some additional information there. Wages paid after death. So there's some different situations that happen if an employee dies, and hopefully this doesn't happen very often. But if the employee dies before cashing their check, the employer would just reissue the check to their personal representative, and everything's reported on the deceased W-2. State law is different. Be careful. And again, wages paid in the same year of death. The taxes they're subject to are FICA, FUTA, and SUTA. They get put on the deceased W-2 boxes 3 and 6. And then you issue a 1099 miscellaneous form for the taxable income in the name of the beneficiary. Let's see. Wages paid after the year of death, those are exempt from payroll taxes, and you do not complete a Form W-2. The entire amount is going to be reported on the 1099 miscellaneous form in the name of the beneficiary. Here's Wisconsin rules, and here's Minnesota rules. W-2s due dates are due on this year, February 1st, 2021. And again, you may request one extension before 2/1 of 21. And for Minnesota and Wisconsin, again, you must file electronically if your informational returns are over 10 forms. And when I say informational returns, I'm talking W-2s, 1099 miscellaneous, 1099 NECs. So if between those three you have more than 10, you have to file electronically. When you're doing your W-2s, you want to do a year-end reconciliation. And here's a sample one that I have. It's a lot smaller than the one last year, if you noticed, because we have a lot more lines on a 941 form now. So this again is included in your handouts, and you would just populate it by your 941 information, enter in your W-3 amounts, and make sure your differences are within pennies. Prior to doing your first payroll in 2021, you want to make sure you update your state unemployment rate. You review and enter any changes for health insurance, those type of things. Any employees that claim exempt from withholding, they have to file a new W-4 form, a new Wisconsin W-T4, or a new Minnesota W-4MN. Those have to be filed each year if they're claiming exempt. If you're adding new benefits, those need to be added to your employees in a payroll software. And you just might want to double check that first payroll just to make sure your taxes are calculating correctly. Now we're going to talk a little bit about exempt and non-exempt employees. And these are kind of your subcontractors versus employees. So exempt employees, exempt employees versus non-exempt is going to be salaried versus hourly. Exempt do not have to be paid minimum wage or overtime, so those are your salaried employees. And again, these standards are set by the Department of Labor. The employer does not have to keep detailed records of their work, so you don't have to have an hourly, I can't think of the word. You don't have to have a timesheet. That's what I'm trying to think. And exempt employees are normally your executive, administrative, professional employees, things like that, outside sales employees. Those are an example. Your non-exempt employees get paid at least minimum wage. They normally have to keep track of their time on a timesheet, and they get overtime for over any hours over 40 hours a week. And again, here's the Department of Labor website that will give you I believe that is for the handout. Now we're going to talk about employee versus independent contractor. I was one slide ahead of myself before. So if you're an employee, your employer controls when you work, how you do the work. The employer is also going to supply the tools and the know-how. They're going to teach you, and they're going to offer you benefits. Maybe PTO, maybe vacation. They don't have to, but that's just out there that if you get those, you are an employee. You are not an independent contractor. Independent contractors normally have written contracts with the customer they're dealing with. Those contracts normally will have the length of the project, what happens, things like that. Your independent contractors are also going to have their own federal ID number, file their own tax returns that show that they're a business, and pay their own taxes, including your FICA taxes. IRS has some common law rules. Behavioral, does the company control or have the right to control what the worker does? Financial, are the business aspects of the worker's job controlled by the payer? And the type of relationship, again, written contract. There's no magic, black or white. It's kind of gray, whether it's an employee or independent contractor. And if you want to be clear, there is a form SS8, a determination of worker status, and that can take up to 6 months for the IRS to get your determination. So it's not going to do you any good if you need somebody now. But just to let you know that's out there if you want to look at Form SS8. If you have questions as to whether they are an employee or independent contractor, a lot of those questions might be answered when you're looking at the determination form. The IRS also has relief provision that if you have been paying an independent contractor for, I don't know, 5, 10 months, and all of a sudden you're realizing, oh my gosh, I think they are an employee. There is some relief available from the IRS, and it is Section 530 relief. And there's a pamphlet out there. Just Google Section 530, and it will give you the ins and outs. I recently just had a client that asked about this and was going to apply for this. So it is out there, and it's a nice way that the government is going to be a little lenient on you, because if you get caught, if you have a payroll audit or a workers' comp audit, and they find that you have independent contractors that should be employees, the fines and penalties are not pretty. They get very expensive. So for independent contractors, you want them to complete a W-9 form, and here's an example of that form. what pretty much all this does is request their name, their business name, what type of entity they are, and their taxpayer ID number, either the Social Security or the employer identification number. And again, with the Form W-9, you cannot truncate the Social Security number. You have to give the full Social Security number. You also will want to request a certificate of insurance because a lot of workers' comp audits require those. If you've ever had a workers' comp audit where you haven't had this information, I've seen what the workers' comp rates have risen to, and it is outrageous. So make sure you get these items. And again, if you pay that independent contractor over $600, you must issue, depending on what they're doing, and this might need to say 1099 NEC, non-employee compensation. And again, another change that I will make. So you have to make sure that you do issue them that form. The penalties are calculated on when you file that form, and it can range from $50 to $550 per form. And actually, I just saw a client of ours have a $26,000 penalty for filing these late. So it's something you want to keep in mind. Make sure you get those 1099 NECs, 1099 miscellaneous filed on time. If the independent contractor does not furnish their Form W-9 or taxpayer ID, if you do not get that, you must withhold 24% as backup withholding. So when you go to pay them, you take 24% off the top, and then you keep that and you send it into the IRS. And again, Form W-9. Wisconsin has different rules for independent contractors. And in this instance, for Wisconsin, a Social Security number cannot be substituted for a federal ID number. So if you're an independent contractor, you're a contractor, and you've been using your Social Security number, for Wisconsin, you should have a federal ID number, and it's very easy to get. You can Google it on the IRS, just Google it and walk through it on the IRS website, and you can get one immediately, and it doesn't cost you anything. So again, Wisconsin has their own criteria, and Minnesota also has their own criteria. So keep that in mind. So Form 1099 miscellaneous. This slide needs to be updated. I'm sorry, I have some slides that are not updated in here, but we can, if we threw that slide away, which I didn't take out, we talk about different 1099 forms. The 1099 series of forms, your 1099B, 1099S, and 1099 miscellaneous, are due to 1 of 21. 1099 NEC, same date. Other payments on 1099s, depending on which form it is, they're due to the IRS by 3/1 or 3/31 electronically. For 1099 forms, there is an automatic 30-day extension, and you can use Form 8809 to request that. You cannot request a 30-day extension on Form 1099 NEC. Here is the 1099 NEC form. And as you can see, it is just the payer information, the recipient information, non-employee compensation, a checkbox that the payer made direct sales totaling $5,000 or more of consumer products to recipient for resale, any income tax withheld. Again, if your independent contractor does not provide their ID number, that's where you would withhold federal income tax. So you're going to use 1099 NEC if you make a payment to somebody that is not your employee of at least $600, and that does include parts and materials. For attorney fees, so your legal fees, not an award or settlement, but the attorney hourly fees that you're paying gets put on a 1099 NEC. Cash payments for fish you purchase from someone engaged in the trade or business of catching fish. So the biggest thing with 1099 NECs are your subcontractors and your attorneys. And if you're a corporation, you still do a 1099 for attorneys. And here we go. Payments to corporations are not reportable normally, except payments to attorneys for settlement and agreements. Those go in a 1099 miscellaneous, box 10. Your legal fees, again, the hourly rate you're paying that attorney. Medical and health care services, and substitute payments in lieu of dividends or tax-exempt interest. Affordable Care Act is still in place. This is where you have to report that the employee had health insurance, and this gets reported on different forms and is applicable to large employers. And applicable large employers have over 50 full-time or full-time equivalent employees in the previous year. If you've got several different companies which are commonly controlled, maybe have the same owners as Company A, Company B, Company C, you have to mix ABC all together for the determination of figuring out if they're a applicable large employer. Different forms you're going to need is you're going to have a 1095A that gets issued by the exchange. So if an employer does not have health insurance and the employee goes to the exchange for health insurance, that's the form that the exchange sends to the employee. And that is due by 2/1 of 21. 1095B is issued by an insurance company and small employers and employers that are self-insured. There's a new due date for this, which is 3/2 of 21, and a new code G, line 8, to identify any individual coverage health reimbursement accounts. And then there is Form 1095C issued by the employer to the employee who is full-time for 1 or more months during the calendar year. 1095C is the most popular one. These forms are required to show that there's health insurance, that they made health insurance available to the employees. If you fail to comply, there are penalties, and they've gone up. And again, here's some information on full and large employers and small employers and the determination factors. We no longer have a penalty if the employee does not have health insurance. So prior to last year, prior to 2020 or 2019, if an employee did not carry health insurance when they filed their their 1040 form, they would get penalized if they didn't have insurance. So that penalty is gone, but the employer mandate is still being enforced. So you still need to, as an employer, if you are an ALE employer, you still need to complete those forms. And if you don't want to complete the forms, we have a service to help you. HAWKINSASH does have a 1095 service that we offer to the general public, and it's run very smoothly. So I included our website. Record keeping. You want to keep all of your records for at least 7 years, and I've also attached a retention guide for you for the website, and that'll give you more of a general, okay, I need to keep this record for these many years, this record for these many years. And the last slide of the day is locations and our phone numbers. So I know we went through a lot of information fairly quickly, and your brain is probably swimming. So if you do have questions, here are our different office location and phone numbers. So feel free to call an accounting services associate at our firm if you need some help. Again, a lot of the information I also provided the website to find it on. If you still have questions, I know a lot of the IRS websites, it's like speaking Greek, and I don't know Greek. So if it doesn't make any sense to you whatsoever, we're here to help you. I'm sure Becky's been busy texting back for questions. I just want to say I appreciate your time today. I hope you learned something, and I will get that handout corrected for you. And when that goes out with the next week with I believe Corey sends the actual recording of this webinar, you will have the correct information. Sorry, I had a few slides that were incorrect, but I am hoping I corrected everything as I was going through. Thank you so much for coming today, and keep an eye on our website for any future webinars we might be having. Thank you so much.